I want to welcome you all to this session considering funding challenges in the challenging labor market, and what does it take to remodel regional pension systems to multi-pillar structures. Today we have a wealth of very experienced panelists. I will begin with ladies first. We have Luna Fadayel. She's a pensions actuary working with Willis Towers Watson in the UK. She's advising many clients on the private sector pension systems and primarily around DB, but she's also an expert on collective defined contribution systems, which have been in the regulatory process in the UK. Matthias Zeeb is an economist of the technical director at Callund, and Callund Consulting is a consulting firm for 30 years, and he's been working on consulting and policy, pension policy issues with governments around the world. We have Farrell Sheridan, who's an Abu Dhabi global markets expert in the Abu Dhabi International Financial Center. He is the head of strategic development with ADGM, where he has been working for the past 5 years, looking after various growth initiatives within the financial center. Prior to ADGM, Farrell worked as a strategy leader in Qatar Financial Center and various financial consulting roles in London. And last but not least, for sure, Tim Phillips, who works for fintech company Smart Pension, and he's also vice president of the Pension Management Institute in the UK. Smart provides the technology platform that is used to operate DUES, the new mandatory corporate savings plan that the IFC in Dubai. And Tim has been working in the pensions industry for about 16 years and currently based in the UAE with a specific focus on the Middle East and Hong Kong. With that, I think I will present myself real quick. My name is Ernesto Brodersohn. I'm your coordinator for this, moderator for this panel. And I'll be happy to entertain all the questions you have along the way. I am a consultant for the World Bank. I have about 15 years experience and a former regulator, and actually a regulator in recovery, I would say, in the pensions industry, working quite a bit in the last couple of years in the pensions, in the informal sector and self-employed workers, pension schemes around the world, also in the Middle East, as well as Africa and Latin America. So I think one of the things, perhaps just to start framing, and we can start getting into the details. I think one of the things that we have seen around the world is that we have seen fundamental challenges, especially in the gig economy workers, in the self-employed. There is a significant change in the way people do business. And actually that challenges the stretch and the way the pensions industry and the pensions Social Security institutes are actually managing and tackling this world. So perhaps we can probably start with ladies first, with Luna, to give us a little bit of an understanding. What do we make of this? How do we see this world? How do we categorize? How do we identify these workers, especially obviously in the Middle East and in this regional world?
Thank you, Ernesto. And also before I start, just to say thank you very much to Mr. Ibrahim of FinTech Robust for the opportunity to be here today. So you posed quite an interesting question. You're right that we have seen the labour market has changed quite significantly over the last few years. And if anything, it's been accelerated by what we've seen this year with COVID-19 and in the way that people work. So it means that the systems that have been in place for many years may not necessarily be adequate to cover these people, you know, whether we're talking just general coverage, or we're specifically here obviously talking about pensions. So, for example, you have many of self-employed people, and then also in the GCC, you have a lot of expatriate workers. And I understand that, for example, expatriates tend to have contracts with their companies where they'll get a lump sum upon retirement, but this isn't regulated in the same way that a pension system is regulated.
So perhaps, Tim, maybe we can get into how do you see these different groups of individuals in how do we see the industry taking on these different types of individuals, and what do you think could be a way going forward in covering these individuals who are usually not covered?
Yeah, thanks, Ernesto. I mean, no one has solved this yet, right? So you raised a really important point about the gig economy, the rise of self-employed people. Here in the GCC, as Luna mentioned, there's a huge expatriate population, and it's quite varied as well. So you have the kind of white-collar workers who are expatriates out here, and then also you've got quite a large number of more manual workers where their financial demographics are quite different to those white-collar workers. So we are dealing with a different landscape. I think if you look traditionally, the way that large pension providers and large pension platform providers have looked at the pensions industry, they tend to have done quite well at managing large amounts of assets from a small number of companies. So when Smart entered this market as a defined contribution pension platform provider, maybe 5 or 6 years ago, how we saw the market was that there are a number of traditional providers who are taking on big companies, they're taking on large contribution volumes for those companies, and they can do that reasonably well. But what no one seemed to be able to do well was scale in terms of employees and employers. Now, when you're looking at reforming any kind of second pillar type system, you have to be looking at how do you make that system work for everyone? How do you make it work? It can't be something that's designed by the financial services industry for the type of people who work for financial services companies. It has to work equally for cafes and bakeries, and all the smaller employers, which do make up a huge amount of any economy, like the GCC economies. So we approached this by building a modern, contemporary pension platform, a cloud-based platform with open data via APIs, like you would expect any kind of contemporary platform within the financial services industry to operate. It doesn't solve the problem for you, but it enables you to look at these cohorts differently and bring solutions to them which perhaps would not have been available to you before. So, I mean, gig economy, we've done some stuff around integrating with banks in the UK, for example. So we have a great partnership with Revolut and with Tide. So some of the challenger banks which have scaled quite successfully, where if you're thinking that if you're an employee, whether it's self-employed or you have maybe a number of different self-employed type jobs, like a gig economy type worker, then how can you reach those people and how can you engender a savings culture with them? One way of doing that is to be able to seamlessly integrate with something like their bank. We know that they have to have a bank account. We know that anyone self-employed with a business or a small business will be having a corporate bank account. So the ability to have open data sharing in that sense does bring an element of connectivity to the end saver that you wouldn't previously have had. But it feels like there's no one-stop solution for this. I suspect it's probably going to be a combination of strong government or public sector direction and legislative change, and expecting the traditional financial service industry to work in conjunction with technology disruptors like smart. I don't think there's going to be one silver bullet that's going to solve it all.
So I think, Tim, you bring up very crucial points on scalability and sustainability of pension systems, which is a challenge that we see in other countries, that we see that is always a challenge, and reaching into these individuals. So perhaps, maybe Farrell, how do we integrate with the financial sector? How do we reconcile the sustainability of the system with reaching these individuals? How do you see this world of the gig economy? How do we reach into them? How do we integrate into the pension systems that exist today, or maybe, and we'll get to the question, are they already fit to be able to manage this?
Yeah, thank you for the question. I think that the UAE in many ways is a little unique compared to, or the region generally is a little unique when it comes to pension arrangements. And actually also the general working culture here, because we don't typically have a particularly large gig economy in the UAE. Most expats who are working here are full-time employees, committed to their company actually through their visa. So, whereas the gig economy is becoming such a prominent part of the developing world, I think we're yet to see that really take hold in the UAE so far. Interestingly, in very recent weeks, both Dubai and Abu Dhabi have introduced freelance visas. So we are recognizing the need to adapt to global trends in this sense, and the introduction of these visas is certainly a step in that direction. And then also the fact that the UAE operates with this end of service benefit principle. So rather than a traditional pension scheme, employees accrue capital as part of their end of service benefit as their tenure at their companies moves forward, and these end of service benefit payments or end of service benefit provisions don't really have the same level of impact, I would say, as a typical pension. They don't, you're not receiving an annual statement telling you how much is in your, how much you're owed as part of your end of service benefit. You're not receiving packs and forecasting tools and planning tools that would enable you to really monitor how much is in your end of service benefit pool and what you can expect to receive when you leave. And I think solutions such as Smart and other data-centric tools that are being introduced are very important, because having visibility of how much capital you have accrued and being able to use that to plan your future and to prepare for retirement are very important. And I think a lot of expats, if they had that and they would realize what is being put aside in terms of end of service benefit contribution, would be able to make much better decisions about properly preparing for their retirement. I think in many cases, end of service benefit will not be sufficient to live on as your sole means of pension. I think most expats would or should be making additional arrangements. And we are seeing now developments such as in DIFC, where they've introduced their dues scheme to provide a more comparable solution to what you might have in the UK, for example, in terms of having a clear defined contribution scheme where you can see your regular commitments going in. You can leverage that knowledge and choose investments appropriate to your risk profile and your age. And Abu Dhabi will be looking at this area as well, and we haven't introduced a scheme such as that currently, but I think there is scope for us to explore doing so in the future. Whether we would follow the same model remains to be seen, but I think we will definitely look to find solutions to improve the way that expats can manage their end of service benefit capital.
That's fantastic, and I think the points that you bring in terms of the leverage of technology, like what Tim has been doing, is crucial. And we have seen a lot of these experiences. And I think Matthias, we've been working on a couple of different countries in the region where we see tech being applied in so many different scenarios. How do we conduct this so that it actually gets to the end result? Is there a role for the state, or is that how do we reconcile this, or what is the state intervention here, or how do we reconcile all these pieces of a puzzle that we need to put together in order for these to be able to bring out the individuals? And I'll get back to a couple. We already have a few questions on the panelists, so I'll weave them back into our discussion. Thank you.
Well, Ernesto, I think there's always a role for the state. The financial sector or the financial industry may be highly innovative and maybe driving innovation forward. But whether that innovation can actually reach large parts of the population who are currently not covered or are completely at the margins of old age security, I think that lies very much also in the hands of government. I think government, and we actually see that at the moment in the pandemic, how big a difference can be made by good government. And I think good pension systems are probably a prime indicator for good government, for good long-term government. So government makes eventually probably all the difference. And if you want to make sure that we have high coverage, and when we're talking about multi-pillar pensions, not only first and now maybe also a second pillar, but then also the zero pillar that would look after those that cannot afford to contribute to either pillar one or pillar two, again, that is government responsibility. But more on the tech side, I think the problem we often see there is that government is always at risk of being one or two steps behind what the industry is already conceiving and trying to apply, and may even be asking for regulation to be put into place to support that. So I think one of the most important elements in this entire complex web of people who have to work together in this, let's call it the pensions ecosystem, this one key important element we would be focusing on here is to have good communication channels between the financial industry and regulators and government on the other side, so that this thinking can actually co-evolve, so that you know, on one side there's a step forward, and you shouldn't wait for too long before the other side catches up, because otherwise things will not be implemented in a way that will actually lead to effective solutions.
Sorry about that. So perfect. So I think this is a good point to cue in our first question, actually, our first poll, and we would ask all the attendees to quickly pull up the poll. I think we can see the poll question shortly. I can't see it, but it should pop up. There you go. I think those are the two big questions. Are the current pension systems fit for the future generations, for these challenges that we've been mentioning? And then the question is, who should lead this innovation? So if you take a few seconds to answer these, And I'll start actually asking a couple of questions that have already started to come into the question and answers. And I think it has to do with some of the things that Farrell, you were mentioning, and Luna, you were mentioning as well. How do we convince individuals? And while we think about that, how do we convince individuals, especially expat workers in the MENA region or the GCC specifically, to actually save and save for pensions in the domicile region that they're in? And I'll give you, let's go back to the question, to the answers. Hopefully we got some answers and we can see them pop back in. We see the results in a few seconds. So let's see. Hello. I think we have a technical difficulty on the answers. Anyway, so I think we can, should we wait, we can wait for the answers as we go along. Perhaps we can go into those, there it is, those that we have. So we seem to have consensus, at least around the audience, on is the current pension system fit for future generations? And we do seem to have 81% of us saying it's not. And who should lead this innovation? I think that's a very good point to the discussion. I think some of the things that you were mentioning, Matthias, that should it be just the pensions themselves or the policy, the financial industry, or should be a combination? Let me go back to the questions again. Perhaps how do we convince people to save? And maybe first Luna, and then I'll go back to Farrell because I think you were mentioning quite a bit on the expats, and I think that's a very good question. How do we convince expats to save in the jurisdictions they're working in? Luna, perhaps if you take a few minutes.
So I think there are a couple of approaches to this. You can use the stick, and the regulation can enforce people to save, whether that's making people save individually, or whether it's forcing companies to, for example, auto-enroll all of their employees into some sort of pension saving system. Now, this is actually what we've seen in the UK with the introduction of auto-enrollment, where all employers need to enroll their employees, but employees do have the option to opt out. So this provides some sort of base benefit, but you can't force employers to do this without offering some sort of support. So, for example, in the UK, there's the Nest scheme, so that if employers can't set up their own pension fund, they can enroll their employees into the master trust Nest. Now, aside from the stick approach, there's also the carrot approach, where you actually incentivize people. So this could be, for example, tax relief where applicable, or it could be savings returns that are higher than perhaps where they would normally invest their assets. But really, to get either of these to work, you need all three bodies that we saw on the screen earlier to work together. I don't think it can be the government by themselves, or the financial industry, or pension funds by themselves either. I think the three groups need to work together, and they also need to communicate to the people who they're speaking to, who they're trying to get to save, so the employees and the workers in the economy.
Farrell, I think those are fantastic experiences, and I might add, we have seen both type of experiences as well. We see the stick approach has been experimented with in Chile, for example, where they introduce a mandatory contribution scheme for the informal, or what they call the informal sector workers, which are also gig economy workers, with some level of success, not 100%. And we have seen also incentives, and we have seen a couple of different experiences across other countries where we see different type of incentives in Mexico, in the Africa region, and we try to also see also linked services, for example. And in Egypt, we've seen linked services with licensing departments. So when you go and actually are a taxi driver and you're self-employed, you actually link into your licensing, and you cannot renew the licensing unless you're actually contributing to the pension system in Egypt, for example. But going back to, I think, Farrell, I think that was a fantastic question on expats. How do we convince expats to save on the jurisdiction where they're working on?
It is a very interesting question. And I think that I would echo much of what's been said already. The regulator, who drives this, the regulator or the private sector? I think that the regulator should certainly be an enabler, potentially a driver as well. But I think in many cases, the regulator relies on the private sector, who have more have their ears close to the ground, have more knowledge on how things are developing. At ADGM, we are so closely engaged with our community of firms to understand new trends in the market, new opportunities that maybe we should be looking at. Whenever we introduce regulations, we put them out to public consultation. So this relationship needs to be very symbiotic and very close, to make sure that you're developing offerings and tools and regulations that enable the environment. In terms of encouraging expats to save more or to save in the local domicile, I think that it's one of the benefits, but also one of the problems that the UAE faces is that we don't have any income tax, which does mean that, although of course most of us are very happy about that, it does mean that that's a lever that we don't have to pull. Obviously, in the UK, for example, tax relief is an enormous lever that the government have to encourage individuals to save more. And that is just not a lever that we have to pull here in the UAE. So we do need to find alternative solutions. I think that the education is the most important of those. You need good products. You need attractive products that are comparable to what that expat can obtain in their home market. And I think that the breadth and depth of products available in emerging markets is always naturally going to be different to what's available in very mature, developed financial markets. So this is something that we are of course seeing improvements in, but it takes a long time to develop the same extent of solutions that a market has that has been operating in this space for hundreds of years. I think we talked there briefly as well about the carrot and the stick methodologies, and I think that where the UK or where other markets that levy income tax have this carrot of tax relief to offer, and it's something that the UAE doesn't have. Maybe there is a need for more sticks to be implemented, but at the same time, of course, we're operating in an environment where we are trying to attract international business. That is really ADGM's DNA, to attract international business to set up in Abu Dhabi and to establish a presence to take advantage of opportunities in the region. So we aren't typically favoring introducing sticks that might impact our competitiveness. So it is a difficult position, and I think that there needs to be ongoing dialogue between the regulator, the financial services sector, the advisory community, and expats themselves, and making sure that as a combination, we are introducing solutions that will be taken up by expats and can actually encourage them to save, to contribute to their retirement, and to do so within the UAE.
I think you touched on a very good point, and I think that reminds me of that precisely on the Chilean experience on the income tax. But I think I'll rely on Matthias' expertise, global, all the different countries that you've been working on. How do we implement this carrot and stick? How do we reconcile these two worlds, or how do we work together, and how do we create these enabling environments that Farrell is mentioning?
Well, that's the $100 million question, I think. Interestingly, we did a survey recently in one of the African countries where we have been working on informal sector pensions. And what really surprised me was that when we asked people in the informal sector whether that new scheme that was being contemplated by the government should be mandatory or voluntary, there was actually a majority of people, and that's the people themselves who would have to pay, saying it should be mandatory. And that sort of went contrary to what certainly I had been arguing for some years about informal sector pensions, that because of irregular income levels and possibly also low income levels, mandatory contributions might be difficult. But I think it's worthwhile trying to take this question apart a bit, because too often before, I think we have thought about mandatory and enforcement in a sense of it has to be as regular a contribution as we are seeing it in the formal sector, where people have a monthly paycheck and a certain percentage is deducted at source even, and you as the employee don't even get to see it. It may appear on your payslip, but that's about it. But I think there's something in between where, and that's where it becomes interesting, where we can have mandatory contributions that vary, that follow people's income. And of course, that then raises the question, how far do you want to intervene in trying to have those, call them gig economy, self-employed, informal sector people, into contractual arrangements where you can actually follow the income stream. And what you mentioned about Egypt, I think, is an interesting case in point. Even as a self-employed person, you have some contact somewhere, in most cases, to the formal economy. And as a government, if that is your intention, that you want to expand coverage, you should make use of those points of contact. So that's where I think then the stick and the carrot can actually come together, because that point of contact often is a carrot where people are interested in having that contact because the government or regulation has something to offer, even if it's only a license. And so that can also become the point of, let's call it stick in inverted commas. I wouldn't drive it too hard, but it can use the carrot as a stick. Let's put it that way.
So I think, Matthias, you were pointing out something really interesting, which actually is very related to one of the questions that we have also from the audience. I think you mentioned it could be incentives, it could be the right hand or the left hand or something in the middle. And I think that points us a little bit to a question that we have. And how do we evolve, especially around the GCC countries, in how do we evolve the pension system? Do we need to create this ecosystem? And do we need a multi-pillar structure to be able to cope with this? And Tim, I'd love to get your point of view when you're thinking about integrating this ecosystem where these things can actually be set up, and how critical are these in terms of the timing? I mean, how do we structure these solutions so that they're really available for these individuals at the right time?
Sure. So you've got an interesting dynamic within the GCC countries, in that you've got this, like Farrell was talking about earlier, you've got this existing practice of end of service gratuities, where companies know that part of employing an expatriate worker is the fact that you have to pay this lump sum to them at the point at which they leave your company. So in a way, then, compared to some other countries, it should be an easier move than you would get where there's no requirement on employers to be paying this money out for employees. So what has happened within the DIFC for dues is that they've taken that model and they've said, well, actually, let's change quite a number of aspects of that. There's aspects of that model which are suboptimal. And if we look to other countries, whether it's Australia or New Zealand or Hong Kong or the UK, then or a number of other countries, and we can see that there's a better way of doing this. So you make sure that it's advance funded for a start. You put it under trust so that you have a trustee, so a master trust structure that is responsible for looking after that money. And you give a range of investment options to employees, but you have a very strong default fund, which is selected by professional trustees with excellent professional advice around what that default should look like. When you've done that, then it totally changes the visibility of those savings for people. It suddenly empowers those people to be able to, any worker, to be able to see how much they've got at any one point in time. And at the point at which they end up leaving employment, then they know that money is safely in the hands of that professional trustee who can go through the process of returning that money to them. So in a way, I think it should be, the poll earlier, right? 45%, I think it was, of people who said that it should be the government policy which should drive this. So I completely agree with that. You can look at, we have mentioned the UK a couple of times here, so I'm slightly wary to do it again, but UK was introduced auto-enrollment in 2008, or it came in 2012, but legislation was 2008. 7 years prior to that, then they introduced something called stakeholder pension schemes, where every company had to give access to saving schemes. Companies didn't have to contribute to it, but if an employee wanted to save within a pension scheme via their payroll deduction, then they had the ability to do so. It really didn't work. There was very, very low take up, and you had to have that additional state intervention, that additional government policy to make sure that people are pushed towards being automatically enrolled, being automatically put into savings. The only way you can change this is by embedding that savings culture very early. There's been a number of studies which have shown the key thing that any individual can do to have a better retirement is to start saving more from a younger age. And anything else that we think, like we would like to think that there might be some magic investment option or something which is going to solve everything for us, but ultimately the one thing that people can do is start saving more from a younger age. That government intervention to create an infrastructure and culture in which people are doing that is critical for that. Once you get past that, I think, just to say a bit about how I think technology should be used in terms of member engagement or employee engagement. Too often, I think technology and innovation is used to overcomplicate things in this space. I think we see a lot of companies who are trying to innovate to make pensions and savings actually quite complicated. And what we try to do is actually make it simple instead. So we have an app. So if you're employed in the DIFC, you can just you can see your balance whenever you like via the app. You can log in with your biometric IDs. You don't even have to remember a password. You can just log in on your mobile phone with your fingerprint. It's things like this which I think actually make pensions and savings accessible to the masses. I saw a bit of kit from a provider maybe a month ago on a session like this, and it was where they were innovating to kind of people could bring in other assets and say, oh, the value of my house is this, and I've got the savings here, and get a total picture of all their wealth and things like that. In a way, it was pretty impressive, but you do think it's so complicated, and it's really it's not something which you can see is going to make this mass appeal to the people working in cafes, the people working in florists, to the whole community. It's not something which is going to democratize pension savings in that way. So I have a real belief that technology should be used to simplify things and make it easy for people, rather than adding layers and layers of complexity on top.
Absolutely. I think the point, and I think one of the things that we have seen is many of the countries introducing tech doesn't solve it unless it actually talks and is tailored to the individuals. And this talks a little bit more on the incentive side, on trying to keep people involved in these themes. And I was wondering, there's actually a really interesting question on guaranteed return funds, and would that be a solution, or would that help? And perhaps Farrell, you can perhaps comment on what do you think, and I'd love to get your point of view, Luna, as well, from actually actual standpoint as well. Would that nudge, or would that stimulate people to saving just because they have some kind of guaranteed return, vis-a-vis keeping the money cold in the banks, in cold bank accounts where they get very nominal, very, very low interest rate? Perhaps Farrell, you can comment on some of these. And feel free to react to the comments before.
Sure. So I think that I think everybody loves guaranteed returns. I think if we knew we could make 10% a year, I think everybody would be delighted to jump in. But I think that the reality is, when guaranteed return products are offered, quite often those returns aren't as high as one might hope. And by their nature, it's very difficult to guarantee very high returns unless you're taking extremely high risk, in which case the asset manager or the investment offerer is exposing themselves to high risk. So I think probably what's more important than that is just broader education. I think we all know, or at least those who operate in the financial services world, and are familiar with principles of long-term saving. We all know the merits of compound returns and the reason why we should be saving from a young age. But not every person, not every expat in every industry has really ever been made familiar with these sort of basic principles. And I think sometimes education can be just as important. I wouldn't suspect that you would see a mass rush to new products that were offering guaranteed returns any more so than you would with product offerings being shown that sensibly demonstrate a range of risk profiles and risk reward profiles. I think people are always able to make their own decisions based on their age, their risk appetite, their views of the market, their general appetite to long-term risk. So I think that it's a possible solution, but I personally don't think that it would be any more effective than having a broad range of good tools that offer interesting range of returns.
Luna, perhaps you can comment on that. I think Farrell, you bring up a good point. The minute you guarantee, you have to be very conservative and probably erode some of the benefit that you're actually placing. And I'll go back to there's another comment on the expensive or cheap savings products from the audience as well. But go ahead, Luna, on the guaranteed returns.
Thanks. So I think this is almost similar to replicating the issue that we're seeing on defined benefits schemes. So if you're guaranteeing a good level of return, then effectively you're providing some form of guaranteed benefit. And the reason that we're seeing such a move away from defined benefit schemes, certainly for the private sector, is that they're very expensive, both to run, but also the actual cost as people are living longer. And also the risks involved with that. So you've got the risk of people living longer, you've got the way the market moves, and if pensions are linked to, for example, inflation, if they increase in line with inflation, then you're exposing yourself to some sort of risk there. And this really reflects the sessions that we heard at the conference yesterday, where they're talking about whether the pension systems in the GCC are sustainable. And the resounding answer, certainly through the polls, was that no, they're not, and something needs to change. So perhaps offering a product with a guaranteed return is just shifting the risk from the government to the provider. And will you get providers that are going to take that risk? I'm not sure, really. And I just wanted to pick up one of the questions that's come through that's quite that's related to this, which is whether a shift to a multi-pillar structure is a necessity or a leisure for government pensions policy, and how critical it is in terms of timing. And again, I go back to the sessions that we heard yesterday. I mean, the resounding answer that I heard yesterday was that, no, this is actually quite a critical, immediate issue that needs to be dealt with pretty quickly. Having an adequate pension is really important, but it's only adequate if it's sustainable. And I think that's the point that needs to be addressed. So some of the solutions that were discussed yesterday were, for example, parametric reform. So either changing contributions being paid in or the benefits that are being paid out. And I think an alternative, or perhaps something that goes hand in hand with this, is the shift to a multi-pillar structure, where perhaps you encourage a move so that employers provide pension, where you educate, going back to what some of my fellow panelists were saying, you educate employees so that they have their own voluntary savings as well.
I think this brings us back, maybe Matthias. How do we go about this? I mean, how do we go about thinking of remodeling the current pension setup that exists across different countries in the GCC towards more of a multi-pillar structure? If that's one of the solutions, and maybe I'm putting words in your mouth in terms of trying to figure out a balance, like you were saying, on both the mandatory and the voluntary, there has to be some form of equilibrium or balance between them. That to me points towards that, but I would love to get your point. And how do we transition? How do we create this infrastructure or how do we transition from the current GCC setup to this type of multi-pillar system that Luna is mentioning?
Well, I think one can refer to countries who have done that before. The problem is that when you look at some of those, in some cases, let's say Poland, for example, which started very much as a reform that aimed for a multi-pillar system and was lauded with justification. it has since become stuck, and governments have actually, at least partly, taken it back again. So even though I support the notion of having multi-pillar systems, I think we are currently in danger of this becoming a kind of new orthodoxy, where this is the done thing until you run into the next trouble, and then it's being withdrawn again. You know, when people notice that in your new second pillar, mandatory, fully funded, the returns aren't actually what people had been hoping for. And at the same time, if you reform sort of overlooked or just pushed to the future, that you have to continue to pay the pensions that have been promised in the existing DB schemes, and that is actually beginning to place a burden on the government that has to make up the shortfall, or on those who continue to be in the first pillar system and have to pay higher contributions, that people then realize the cost of good old age incomes has to be borne by someone. And you can have multi-pillar systems and they can help to balance out who pays that cost, but only if you make that move very much conscious of that fact. The cost doesn't disappear. So I think the technical question of how do we get about it, you know, having your first pillar reformed with parametric changes to bring it back to long-term sustainability, then adding the regulation for a functioning, fully funded second pillar, mandatory, make it competitive, whatever. I think all of that is doable, and there are even blueprints for it. But the key point, I think, still is you cannot achieve the same level of coverage you have today with the same level of cost, which today is not sufficient. Even with a new second pillar, the cost, the total contributions people pay or the government has to add has to go up. It cannot stay at the current level. And I think that is the basic new, maybe not so new, but the basic new understanding that has to be accepted.
I think you bring up a fantastic point. The question on costs, no, and I think it brings back the question on how do we leverage technology, and I'll go back to Tim on leveraging this technology to reduce at least some of these costs that Matthias is mentioning. And I do agree there must be something has to be made in order for us to be able to reach. How do we, there's a multi-pillar system and we need the infrastructure that we talked about. And then there's the tech portion of it, which, like you were mentioning earlier, using tech that works for these individuals. And I think it goes back to the question of who leads it. Is it, and the question who leads it is probably twofold. No, one is from the innovation standpoint is one of the dimensions of who leads it. And the other point is who is bearing the costs, at least at the beginning. And I think earlier on, I think Farrell, you were mentioning was on scale, and I think Tim, you were also mentioning the question on how do we reach schemes with a given enough scale so that they are sustainable in time? And how do we leverage this technology? What is the right equation? Is there one size fits all, or do we need to cater specifically to the different jurisdictions? And I'm not only talking about between different regions, MENA versus Latin America or Eastern Europe, but also within GCC. Do you think there's a case where things have to be tailored specifically for the different jurisdictions? And how do we leverage on technology? And I think the cost issue is always at hand. And where do people intervene? And I think, like Matthias earlier alluded to, there has to be, and I think you were also mentioning them, many different stakeholders have to be in place and coordinate between themselves to be able to do this. And who bears some of these costs, and who bears the innovation, and who's putting these things together. And I don't know if there's a single answer to all of these questions for all the countries, or how do we tailor that to specific countries or regions? Tim.
I mean, the cost takes a number of different types of costs, right? So you can look at things like the annual management charge. You can look at the amount that individuals are expected or compelled to pay into a second pillar system. You can even look at the cost for a particular country of actually establishing a scheme like this. So I think Nest was mentioned earlier as an example in the UK, where there is this default provider of last resort, or however they would be described, where the taxpayer has funded this pension scheme to come along. Now, there's been some successes of that, but equally, the contract for the company that runs Nest is £600 million over a 10-year period, which some people would argue is not value for money for the taxpayer, when actually the market could probably arguably have taken that membership on themselves. So there's one interesting area for me. I've been very fortunate to have spent quite a bit of time over the past couple of years in Hong Kong, connected to the reforms that are happening there. So Hong Kong has had pensions auto-enrollment for over 20 years now. I think 21 years they've had it. So quite a long time, people have had this culture of being contributing to what's called the MPF system, the mandatory provident funds, which are like master trusts. There's currently 14 providers in that marketplace. So there's been a bit of market contraction, and there are 14 providers. There are only 2 of those providers that have significant scale. So over 50% of the market is taken up by 2 particular providers, which is HSBC and Manulife. The remaining 12 providers share the minority of the market between them. For a while, the regulator there, the MPF authority, has been attempting measures to try and get the markets to become more efficient and more innovative. And then eventually, a few years ago, they went down quite a radical approach, which was that they had been waiting for too long for the markets to sort themselves out. And they said, well, what we're going to do is we're going to introduce a new centralized platform, which is a single platform that all of those 14 schemes have to use. Any employee within Hong Kong and any company within the Hong Kong would use a single platform. That's a huge project that they've undergone, but they'd waited too long for the markets to sort themselves out. You had a situation, or you still have a situation now, which on their official statistics, you've got 4.3 million members of MPF schemes. And the industry produces 375,000 pieces of paper every week, which is just astonishing that you can have this supposed scale and supposed 20 years worth of experience, and you're having that volume of paper being produced every single week. So I think that's a really good example of where the industry has needed that strong progressive move from public bodies. And I think the only way that you can achieve lower costs, more efficiency, and more innovation is to have that strong direction pushing it in the right way.
I think so. A couple of things. I think the nest example is really important, and I'm not sure the default description is as precise as maybe they cannot refuse, because the employer can always choose. But I think the example that you're bringing out in Hong Kong about trying to set up a platform to share among different, and whether the industry is positioned so that in different countries. I've seen this discussion in other jurisdictions where a common platform can take many different shapes. One is a pure administrative platform to actually manage a lot of the record keeping for the individuals, where you can leverage. And the other is a simple, more switch that facilitates interaction for all the users and facilitates contribution collection, especially when you have harder to reach individuals who don't have these access to bank accounts. Which brings me to this question on, do we think that financial markets are ready? I mean, and I think this question is in a couple of different senses. Is one, the first is these contributions will flow, if they're mandatory, they will flow similar to what you see in the world of occupational pension schemes. But in the voluntary schemes, they will flow in a more haphazard way than you see them. And I'm wondering if the financial market is ready in the GCC, and I think I would rely, maybe Farrell, if you can comment on that. And I think, do we think the financial markets are ready, and do we have all the access points in the GCC so that individuals can make contributions in a very easy way? And I think that this question on what do we need to do so that financial markets can actually manage both being able to make contributions and being able to receive these contributions at odd times, and I think, as Matthias mentioned earlier, where they have maybe irregular income, especially gig economy workers. And the asset management on the other side also has to be able to aggregate these contributions and manage these in a different way than it usually is, because they already have some form of predictive mechanism to collect larger chunks of funds flowing into the funds per se. So I don't know, perhaps Farrell, if I can pick your brain on that, I'd love to hear your point of view.
Sure. Well, I think the UAE is actually kind of relatively unique in many ways, in the sense that within the UAE, within the single country, we have, of course, various emirates, and then beneath that we have various free zones, like ADGM and DIFC. We're actually established under federal law, which fully carves us out as a distinct legal jurisdiction, and enables us to control our own regulatory environment. So within one country, we have multiple different regulatory environments. The end of service benefit principle is common across all jurisdictions within the UAE, but is applied differently in some ways. So we in ADGM we have end of service benefit regulations. We do allow our companies to opt out if they already are part of an international pension scheme. The majority of our companies are multinationals that are establishing a regional presence in Abu Dhabi. So if they're already operating a robust pension scheme for their employees, then we're more than happy for them to use the same scheme in Abu Dhabi as long as they can demonstrate that. But these end of service benefit payments are cash. It's cash requirements. So when an employee leaves employment with a particular employer, they are required to meet this end of service liability that has accrued over the employee's tenure. But it is just held in cash, or in many cases not even held in cash, just a liability on the balance sheet. So a lot of this capital that's accruing isn't actually finding its way into the financial markets. And of course, for the majority of developed countries, and actually for many emerging economies as well, pension capital is a vital part of the liquidity of their financial market. So it is important, and it is very highly beneficial for pension capital to flow into local financial markets. Now, I don't believe that, and I think this is the case for Jew scheme as well, there is any requirement for that accumulated capital to be invested in local financial markets. And given the kind of depth of the financial markets in the UAE being relatively shallow compared to international markets, it wouldn't be it might not be a natural home for all of that capital to flow into the local markets, because there simply isn't the availability of products. But I think ultimately what we would be hoping for and aiming for is that at least a proportion of that capital finds its way into local financial markets and benefits the local financial markets. I think what you may find is a slight reluctance for some expats to have their capital invested in the local financial markets, because firstly they're not as familiar with them as they might be with the FTSE 100 or the S&P 500 or the very well-known international indices, and also potentially because they feel that they're already highly long the country they're operating in, and they might want to hedge their position slightly by investing more back in their home market. There are all these variables and factors at play here, but I think ultimately, we would love to see the local end of service benefit capital, at least in part, finding its way into the liquidity of the local stock markets.
Perhaps I'd love to hear Luna's point of view on the governance. You've been advising many other employer schemes, and I think we have another question on shift changing from DB to DC schemes, where we do need extensive education as well and enforcement that these things, and I think we're touching on governance issues. And I think there was an earlier question on how do we make sure that these, whatever these schemes are truly enforced, and whether it's end of service or it was structured a truly DB or a DC scheme. How do we structure the governance around all of these schemes to make sure that they truly fit their purpose? And I think one of the comments that Matthias has said was saying earlier, it doesn't solve everything because we don't know if we have the adequacy. And Matthias was raising the adequacy issue earlier. I know there's a lot of questions there, but I'll let you intervene, Luna. Thank you.
So governance is one of the probably the biggest points that pension schemes face, both privately and publicly. Running the pension scheme, you have to get it right if you want the members to be paid their pensions. But governance also creates quite a big headache for people who run pension funds. You've got all the operational governance side of things. How do you make sure that you've got the right people in place to make the right decisions? Tim mentioned earlier having trustees who who, for example, manage the asset fund in the pension scheme and look after the benefits. So that's an example of how you can set up the governance in the fund. And then they in turn can look to experts in other fields. So investment advisors, I'd like to throw in actuaries since I'm an actuary. But it's just trying to manage that expertise to make sure that things are run effectively and to achieve the best outcomes. Now, moving from, say, DB to DC, moving totally, so the question is what may prevent moving totally from DB to DC? Even with education, there could be a little bit of resistance. And the way it's seen, certainly in countries where this has been done before, is that DB is the gold standard. You know, it's the thing that everyone wants, because as an employee or as a member, you're not taking any of the risk. It's all with either the employer if it's a private pension scheme, or the government if it's a state scheme. So moving away to DC, where instead the risk now moves to the member or the employee, it's quite a big shift in culture. But to balance that, you have to think, well, if it's just DB and the pensions can't be paid if the company goes bust, or that the government can no longer pay those benefits, then that's also quite a big risk to the member. So educating those members and employees to demonstrate the difference is quite key.
We're about a few more minutes away from the end of our fantastic conversation. I would definitely like to hear maybe some final thoughts from Matthias, Farrell, and Tim on this fantastic conversation. I think we are only, from what I've seen as well in other countries, and I think there isn't still a one-size-fits-all, and I think we still need to figure out what the right equation is. There are clear steps in the engagement that governments, financial industry, and the overall associations and the society in general need to take. But how do we proceed is a challenge in trying to find out what the exact solution to this equation is on different countries. So perhaps I'll let Matthias probably take a couple of minutes to wrap the final comments from everybody in the panel before we end the session. Thank you.
Yeah, thank you, Ernesto. Yeah, how to conclude this? I think ideally we would reinvent the wheel in a sense that I think we need to be aware that old age security will always have an element of collective responsibility. I don't think there is a way to do that on your own. You know, even if you save a lot, once you are old, even the value of your savings depends on what the working age people do. Because if you own shares in a company, if the people in that company don't run it properly, all your savings are for nothing. So that collective element, even in funded arrangements, is there. And I think that is important not to forget, because it indicates that there has to be a role for government trying to look at the whole and setting the scene for the different players in the financial industry, in those government agencies that regulate or that run schemes, to work together towards a joint objective, having old age security for the entire population. And the second point, I think, is what you were saying, Ernesto. Countries are different. And we heard just now that capital markets are different from country to country, and you cannot automatically assume that by introducing a second pillar and hoping for your capital market to pick it all up will not automatically work. So it takes consideration, and it may mean that even though you want to have a second pillar, and you maybe even will have one, it should not be as prominent as in other countries where the capital markets will be more easily able to absorb all that additional money flowing into them.
Thank you, Matthias. Farrell, I will let you also answer a couple of very specific ADGM questions as well.
Sure. Yeah. So I think there has been a couple of questions coming in here about whether ADGM would be taking any measures to support the private pension market, and I think that we should address that it is something we are evaluating. We do already have the requisite regulatory environment for companies to set up trust schemes, end of service benefit trust schemes in ADGM. We do have a number of them actually already established. We haven't mandated any specific types of setups that have been included in some other jurisdictions. But I think ultimately it is something we are evaluating, and we will update everybody as our thinking in this area progresses. I think generally we're a little reluctant to implement anything that imposes cash issues on companies during the current environment we're facing. But we do support better management of end of service benefits, and it is something that we would like to approach going forward. So it is under evaluation. I'll leave it at that.
Fantastic, Tim. Perhaps a couple of final thoughts, and we can wrap it up. Thank you.
Sure. Yeah, I think just to end on a positive note, really, I think I'm consistently impressed and remain to be impressed at the ability of the Gulf region to push through reforms and the ability to take an agenda and at pace make it happen for the better of the citizens in the GCC countries. So I've got a lot of faith that whilst we have highlighted quite a number of issues here on this call, I've got a lot of faith that given the correct agenda and the correct impetus, I think there could be a model that is really quite impressive in this region. And it's an exciting place to be doing business.
Of course. Well, I'm left with concluding remarks, not only for our session. We've had fantastic speakers and panelists today, but I have to thank the organizers and all the other panelists and the speakers that were in the other earlier sessions over the last 2 days, and all the delegates and the assistants that participated in this Arab Pensions Conference. We will be eager to wait for the next year's Arab Pensions Conference in 2021, hopefully in face-to-face mode. And we have seen fantastic lessons and recommendations that have come up, not only from this session, but from all the other sessions as well. With this, I'd like to conclude and again thank my personal thank you to Ibrahim for inviting me to be participating on this, and for all the participants with the patience of being about 9 hours behind you all. And I thank you all for a great session and a very good, fantastic discussion. I look forward to keeping on the discussion on this important topic. Thank you, everybody, very much, and have a good afternoon to you all.
Thank you all.